Hi, I'm Jonathan Wild, and we are going to cover how to record the issuance of premium bonds. To determine whether a bond sells at a discount or at a premium depends on two things. The first is the contract rate, which is used to determine interest paid in cash by the issuer. The second factor is the market rate, which is the interest rate lenders demand for loaning money. The higher the risk of not being repaid, the higher the market rate. So when a bond is issued with a contract rate that is higher than the market rate, the bond sells at a premium. This is because the bond's contract rate is higher than what lenders expect for that bond's risk. Therefore, the bond issue price is higher than the par value, meaning that the issuer gets more money at issuance than they will pay back to the lender at maturity. All right, I think it will help us to do an example. Let's assume a business issues 5-year bonds on December 31st with a 6% annual contract rate. The par value of these bonds is $100,000 and include semi-annual interest payments. However, the market rate for these bonds is lower than the contract rate and therefore sell at a premium price of $102,000. To record the issuance of the bonds, we record a debit to cash for $102,000, a credit to premium on bonds payable for $2,000, and a credit to bonds payable for $100,000. Cash is debited for $102,000 because this is the cash received from the sale of the bonds. Premium bonds payable is an adjunct liability account that has a normal credit balance. This account increases the carrying value of the book value of the bonds payable reported in long-term liabilities on the balance sheet. Last, we credited bonds payable for $100,000 because this is the amount owed to the lender when the bond matures.